Master the curriculum with Study Buddy by Dr. Lay, independent of CFA Institute. Let's go.
Thanks for checking in with us today. You will find all of our conversation tied directly and accurately to the CFA curriculum. I am DigiJames, along with my co-host Dr. Lay's digital twin TalLe. Together, we will help you prepare for the exam thoroughly.
Hi everyone, it's great to have you with us. The learning outcome of today's podcast is how business cycles affect short and long-term expectations.
If you could predict exactly when a recession ends, would you be the richest person on earth? Or are you still going to get trapped by the information-less average?
The number one reason candidates fail asset allocation isn't the math, it's forecasting bias, specifically ignoring how the business cycle anchor shifts based on your time horizon. Here is the logic you need to beat the CFA Institute's favorite traps. James, why don't you start with your witty analogy?
Here it comes. Imagine you're trying to track a golden retriever on a leash in a park. The path the human walks is the trend rate, but that dog, the business cycle, is zigzagging everywhere.
That is a precise starting point, James. The trend rate of economic growth acts as the vital anchor for very long-run investment expectations. In the long run, those zigzags or deviations from the trend eventually wash out and become irrelevant. However, for short to intermediate term horizons, these fluctuations are the primary drivers of aggregate economic activity like GDP. We define the business cycle as a superposition of many cycles with different frequencies and random intensities. This complexity is exactly why identifying turning points in real time is notoriously difficult for analysts.
So the human is steady, but the dog is chaotic.
Exactly. And the chaos comes from the interaction of uncertainty and rigidities. Rigidities are those pesky things like long-term contracts or slow price adjustments that prevent the economy from fixing itself instantly. Most of this uncertainty is endogenous, meaning it is generated within the economic system by competitors or policymakers. We also face exogenous shocks, which are outside forces like technological breakthroughs, weather patterns, or geopolitical shifts. On the exam, if you are asked to monitor the cycle, you must look at GDP growth, industrial production, and the output gap. The output gap is simply the difference between where the economy should be on its trend and where it actually is.
It's like the dog seeing a squirrel, that's an exogenous shock, and suddenly the leash is tight.
A very apt analogy for a sudden shift in economic momentum. The curriculum notes that the US has seen 34 cycles since 1854, averaging about 59 months from peak to peak. Interestingly, the expansion phase or the climb to the peak usually lasts much longer, about 42 months than the contraction phase, which averages only 17 months. When setting expectations, we must categorize these movements into 5 distinct phases: initial recovery, early expansion, late expansion, slowdown, and contraction. Each phase has a unique capital market effect that dictates how stocks and bonds will behave.
5 phases? That's like a 5-act play where the ending is always a market crash.
It certainly feels that way when a financial crisis punctuates the final act. In the first phase, the initial recovery, the economy begins to pick up from the trough, which is the lowest point of the cycle. During this short window, the negative output gap is large, meaning the economy is underperforming its potential, and inflation is usually decelerating. Because the central bank keeps stimulative policies in place, short-term interest rates and government bond yields remain very low. This is a Goldilocks moment where risky assets like small-cap stocks and high-yield bonds typically start to perform exceptionally well.
So, initial recovery is when the dog finally stops barking and starts walking again?
Precisely, but stay alert for the transition to early expansion. In this second phase, the economy gains momentum. Unemployment finally starts to drop, and businesses increase production. While the output gap is still negative, the central bank begins to withdraw the stimulus, causing short-term interest rates to rise. This withdrawal causes the yield curve to flatten, which means the gap between short-term and long-term interest rates is shrinking. Even with rising rates, corporate profits rise rapidly, and stock markets generally trend upward.
If I'm listening at the gym right now, I'm basically in the early expansion of my workout, getting momentum.
Let's hope you don't hit the late expansion too quickly, James. That third phase is where the output gap closes and the economy risks overheating. You see a boom mentality where unemployment is low, but wages and inflation are starting to climb dangerously. To fight this, the central bank makes monetary policy restrictive, pushing interest rates even higher to achieve a soft landing. Consequently, the yield curve continues to flatten, and cyclical assets might actually start to underperform while inflation hedges like commodities take the lead.
This is the part where everyone gets cocky before the fall, right?
Exactly, which leads us directly into the slowdown phase. The economy approaches its peak as rising interest rates and accumulated debt finally start to bite. Business confidence wavers, and the economy becomes incredibly vulnerable to any unexpected shock. A critical sign here is when government bond yields top out and then potentially decline sharply as investors anticipate a crash. You might even see a yield curve inversion where short-term rates are higher than long-term rates, which is a classic warning of trouble ahead.
So the dog has seen the squirrel, the leash has snapped, and now we're in the contraction. This is the part where everyone hides under the bed, right, TalLe?
Precisely, James, though for a portfolio manager, hiding is not an option. The contraction phase, or recession, typically lasts 12 to 18 months and is often triggered by a sharp drop in investment spending. During this period, firms cut production aggressively, profits drop, and the economy is frequently hit by major bankruptcies or financial crises. From a capital market perspective, the central bank begins easing monetary policy once the recession is confirmed, which causes short-term interest rates to drop. This downward pressure on short rates, while long rates stay somewhat higher, causes a yield curve to steepen substantially.
It's like the dog finally wore itself out and is taking a nap, but the owner, the central bank, is already trying to wake it up with treats.
That's a clever way to view the stimulative treats of lower rates. However, here is the nuance. The stock market usually starts to rise in the later stages of a contraction, well before the actual economic recovery emerges. On the exam, if they ask you to identify the turning point, remember that credit spreads, the extra yield investors demand for taking on default risk compared to safe government bonds, remain elevated until a trough is clearly in sight. Investors need to see that firms can roll over their debt, which means replacing old maturing debt with new loans before those spreads narrow.
So the market is like a psychic. It starts celebrating the party before the guests even arrive.
It tries to be, but it's often a noisy psychic. This brings us to the first major Level 3 trap, the difficulty of distinguishing between cyclical forces and secular forces. Cyclical forces are the temporary ups and downs of the business cycle, while secular forces are long-term, structural shifts that can last decades. For instance, after the 2008 crisis, interest rates stayed low for much longer than any cyclical model would have predicted because secular forces were at play. If you only look at the business cycle dog, you might miss the fact that the park itself is changing.
Like trying to play fetch while the park is slowly being turned into a parking lot.
Exactly. Furthermore, the connection between the real economy and market returns is subject to substantial uncertainty. Market prices are a composite of investor expectations and their risk appetite, their willingness to take on uncertainty for a potential return. Because of this, business cycle analysis generates a noisy signal. The signal is most reliable, meaning it has a high signal-to-noise ratio over a 1 to 3 year horizon. Anything shorter is just random market noise, and anything longer starts to average out over multiple cycles.
So, for the exam, if I'm looking at a 6-month window, I'm basically guessing, but at 2 years, I've got a roadmap?
Effectively, yes. In the 1 to 3 year window, you are within the range of a likely expansion or contraction phase. But here is a critical GPS check. We've learned that the cycle has 5 phases, each with specific bond and stock behaviors, but secular trends can override these. Now we need to understand how the time horizon itself changes the math of your forecast. As the horizon extends, your projection must shift toward the informationless average.
Information-less average sounds like my high school report card.
Not quite. It simply means that over a long enough period, say 10 years, you will likely experience both booms and busts. Therefore, your expected return should converge toward the long-term historical average, regardless of where the dog is standing today. If the economy is in a contraction right now, your 3-month forecast will be very negative, but your 10-year forecast will look much more like the standard 8% annual return we see in historical models.
So the longer the leash, the more the dog just looks like it's following the human.
Precisely. On a 10-year horizon, the frequency of expansion and contraction months is likely to hit that 2-to-1 long-run ratio. We've just covered how the cycle works and why your look-ahead distance changes your answer. Next, we need to dive into the specific math of regime switching models to see how we actually calculate these probabilities for the afternoon session.
All right, TalLe, let's talk math. If I know the economy just face-planted into a contraction, why can't I just multiply that monthly misery by 12 and call it a year?
Because, James, that would ignore the transition probability. In Level 3, we use a statistical model that divides the business cycle into 2 regimes, expansion and contraction. If you are in a contraction, there is a constant probability of transitioning back to expansion. According to historical NBER data, expansions last about 39 months on average, while contractions last about 20 months. This means the economy isn't just a flat line. It's a series of switches flipping back and forth.
So it's like a game of chutes and ladders. If I'm on a chute, the contraction, I'm eventually going to hit a ladder, the expansion. The longer I play, the more likely I am to hit both.
Exactly. Let's look at the verbal formula for the long-term expected return. If equities return plus 2% per month in expansions and minus 2% per month in contractions, and we know the economy expands roughly 2/3 of the time, we weight those returns by their frequencies. You take 2% times 2/3 plus minus 2% times 1/3, which gives you a long-term average of 0.67% per month, or about 8% per year. This 8% is what we call the information-less average because it represents the long-run equilibrium where current cycle data has washed out.
So if the boss asks for a 10-year forecast, I just give him the 8% and go to lunch.
Effectively, yes, because over 10 years, the starting point, whether we are in a recession today or not, becomes statistically insignificant. However, for a 3-month forecast, if the economy just entered a contraction, you must stay close to that minus 2% monthly figure, totaling roughly minus 6%. The Level 3 secret here is the 1-year forecast. Since contractions average 20 months, there is a modest probability that you'll transition to expansion within that first year. So instead of a full minus 24% annual drop, your forecast might be slightly less painful, say minus 18%, because you are adding a tiny bit of weight to a potential recovery.
It's like predicting the weather. If it's raining now, I'm 100% sure the next 5 minutes will be wet. But by next week, it'll probably just be the usual average of sun and clouds.
That is a perfect mental model for averaging over the cycle. On the exam, if you are asked to justify why a 5-year forecast is higher than a 1-year forecast during a recession, you must state that the longer horizon increases the probability of spending time in both phases. You must mention that while the starting point, that is contraction, still carries some weight, maybe a 0.40 weight instead of the long-term 1/3, the forecast must begin to converge toward the long-term trend.
So the win here is knowing that time heals all portfolio wounds, at least mathematically.
Mathematically, yes, but only if you don't let forecasting bias trick you into thinking a temporary contraction is a permanent state. We call the short-term view a noisy signal. If you understood this regime breakdown, you're going to need to understand how these cycles specifically move interest rates across the 5 phases to survive the morning session.
TalLe, let's spice things up. What if the economy isn't just kind of growing? What if it's sprinting? Let's say the expansion returns jump to plus 4% a month, but the contractions get even nastier at 3%. Does the informationless anchor still hold?
It holds, James, but the anchor point shifts based on the math of the frequencies. Let's use those new numbers. If we expand 2/3 of the time at 4% and contract 1/3 of the time at -3%, the calculation becomes 4% times 2/3 plus -3% times 1/3. That results in a monthly expected return of 1.67% or a massive 20% per year. This is still your informationless average, the long-run equilibrium, where the specific starting point eventually washes out over a long horizon.
A 20% annual average? My boss would think I've been reading science fiction, not the CFA curriculum.
Perhaps, but the logic remains rigorous. The longer the time horizon, the more likely the portfolio will experience both regimes, leading the forecast to converge toward that long-term average. However, if we just slip into a contraction, the shoot in our game, and you're looking at only a 3-month window, you can't use that 20% figure. You'd be looking at a cumulative -9% for the quarter, because the probability of the regime switching that fast is incredibly low.
So for the 3-month forecast, I'm basically staring at the floor, but for the 10-year, I'm looking at the stars?
Exactly, but the level 3 nuance is the 1-year bridge. Since the average contraction lasts 20 months, a 12-month forecast shouldn't just be a straight -36%, which is -3% times 12. You have to account for the modest probability that the economy transitions to expansion before the year is up. Your forecast might only be -28% because you're adding a small weight to the potential for a 4% month near the end of that year.
It's like being in a dark tunnel that takes 20 minutes to walk through. After 12 minutes, you're still in the dark, but you're allowed to hope you might see a flashlight soon.
That is a very accurate way to visualize transition probabilities. In Kim's model, as the horizon extends to 5 years, it becomes very likely the economy will have spent time in both phases. Because we started in a contraction, we might still give that phase a higher weight, say 0.40 instead of the long-term 0.33, but the influence of the current state is rapidly fading.
So, for the exam, if they change the return numbers on me, I just need to remember to weight them by the time spent in each room?
Precisely. If the question asks you to formulate a 10-year expectation, you focus on the long-term frequency ratio of 2:1 for expansions versus contractions. The starting point becomes informationless because over 120 months, the initial phase is just a small fraction of the total experience.
So TalLe, we've got the dog on the leash and the chutes and ladders math down, but how do we actually know which act of the play we're in? Is there a dashboard for this?
Absolutely, James. To identify which of the 5 phases we are navigating, analysts monitor a specific set of variables. The curriculum highlights GDP growth, industrial production, and employment levels as the primary vital signs. But the real level 3 secret is the output gap. The output gap is the difference between the actual value of GDP and the GDP estimated as if the economy were on its steady trend growth path. Think of it as the slack in the system. A large negative gap means the economy is underproducing and has room to grow without causing inflation.
Like a car engine. If you're idling, you've got a big gap before you redline. But how do we see the red line coming?
We look at leading indicator indexes and orders for durable goods. Those are big ticket items, like machinery or appliances that last a long time. In the initial recovery, we often see an upturn in spending on these durables and housing because stimulative policies make borrowing cheap. However, the trap here is that business cycles are not well-defined identical loops. They vary in duration and intensity because they are the result of many underlying stochastic, which just means randomly determined cycles hitting the economy at once.
So every cycle is a limited edition version of a crash?
Precisely. For example, while the average US cycle lasts 59 months, the shortest was only 17 months, and the longest was 146 months. On the exam, if you are asked why it's hard to predict a turning point, that's the peak or the trough where the direction of growth changes, you must mention that these cycles are a superposition of many frequencies. It's like trying to predict the exact moment a wave hits the shore when 3 different storms are pushing the water.
That sounds like a nightmare for my portfolio. Is there any safety gear we should be wearing?
The safety gear is understanding how different assets react to these specific shifts. In the slowdown phase, for instance, firms keep raising prices to stay ahead of rising costs, which keeps inflation high even as growth stalls. During this time, you want quality stocks, companies with stable earnings that aren't as sensitive to the economic weather, and interest-sensitive stocks like utilities. If you try to stay in cyclical assets during a slowdown, you'll likely underperform because they are the most vulnerable to the coming contraction.
So quality is the umbrella when the slowdown clouds roll in.
Exactly. And as we transition into the contraction, keep an eye on credit spreads. These spreads typically widen and stay elevated until investors are sure companies can pay off their near-term debts. We've now covered the indicators, the output gap, and the specific asset rotations. To be mathematically precise, we have synthesized the entire framework provided in this module. We started with the concept of the trend rate as a long-term anchor and moved through the 5 phases of the cycle: initial recovery, early expansion, late expansion, slowdown, and contraction. We've even dissected the capital market effects for each, from the narrowing of credit spreads to the steepening of the yield curve.
So we've basically hiked the whole mountain? No hidden caves or trap doors left in the text?
There is one final nuance in the text we should highlight to ensure total mastery. The curriculum mentions that recessions are often punctuated by what I call the Great Unveiling. When credit gets tight and the economy contracts, that is when major bankruptcies, uncovered frauds, or aggressive accounting practices, things hidden during the boom mentality, finally come to light. On the exam, if they ask why a contraction feels so frightening, it's because these shocks exacerbate the downward pressure.
It's like when the tide goes out and you finally see who's been swimming without a suit.
A classic analogy, James. We've also covered the regime switching logic of Lee Kim's model, emphasizing that over a 10-year horizon, your forecast should converge to the informationless average of roughly 8% because the cycle frequencies eventually normalize. This concludes the core logic of the provided text.
If you've survived this deep dive into the 5 phases, you're ready to stop guessing and start allocating. You're going to need the next section on international capital market expectations to see how these cycles clash across borders. All right, TalLe, let's wrap this up. If the listener is currently on the treadmill or stuck in traffic, let's give them the ultimate mental table to memorize before they hit the shower.
Excellent idea, James. On the exam, the CFA Institute will often describe an economic environment and ask you to identify the phase or predict the asset behavior. Let's break this down with analytical precision, James. When we analyze the initial recovery, we are looking at the immediate aftermath of the trough. The economic vibe is characterized by a large negative output gap, meaning actual GDP is far below its trend potential and inflation that is typically still decelerating. On the capital market side, the win is recognizing that because stimulative policies are still in place, short-term rates and government bond yields stay low. This creates a massive tailwind for risky assets. Small cap stocks and high yield corporate bonds attract investors who are moving out of safety as the fear of a long depression dissipates.
So, in the recovery, the economy is still in the hospital, but the stock market is already checking out and headed to the gym?
Exactly. Now let's pivot to the late expansion. This is a dangerous phase where the output gap has closed and the economy is in danger of overheating. You'll see low unemployment and strong profits, but here's the trap. Wages and inflation are rising. To prevent a total blowout, the central bank shifts to restrictive monetary policy. For your portfolio, this means interest rates and bond yields are rising, which causes the yield curve to flatten. In this environment, cyclical assets often start to underperform, while inflation hedges like commodities take the lead because price pressures are peaking.
It sounds like the late expansion is that part of the party where the music is too loud and the neighbors have already called the cops.
Precisely. That brings us to the slowdown, which is arguably the most nuanced phase to identify. The economy is approaching its eventual peak, but business confidence is wavering because of rising interest rates and accumulated debt. Even as growth slows, inflation often continues to rise as firms desperately raise prices to cover their own rising costs. On the exam, if they ask you to justify an asset shift here, mention that the yield curve may invert because the central bank is still pushing short rates up, while long-term bond yields start to top out or decline in anticipation of a recession.
So when the engine starts sputtering in a slowdown, I should be looking for the quality seatbelts?
That is the exact call to logic you need, James. During a slowdown, quality stocks, those with stable earnings and strong balance sheets, plus interest-sensitive stocks like utilities, perform best because they can weather the lack of growth better than high-leverage companies. If you understand that the slowdown is the transition from a boom to a bust, you can predict the flight to quality before the contraction officially starts.
If you've got these three phases memorized, you're not just guessing. You're basically the house at a casino. You always know the odds.
And if you want to ensure you don't get wiped out when the cycle turns, you'll need to understand the specifics of the contraction phase, where the informationless average becomes your only friend.
So, if I see the words yield curve inverts, my brain should immediately scream, slow down.
And if you see monetary easing and sharply dropping profits, you are firmly in the contraction. One final level 3 secret. Remember that the stock market is a forward-looking animal. It usually starts to rise in the later stages of a contraction, long before the GDP numbers actually look good. If you wait for the news to be positive, you've already missed the recovery rally.
It's like the dog starting to run toward the door before the owner even picks up the leash. He knows what's coming.
Exactly. To justify your choices on an essay question, always link the phase to the output gap or central bank action. For example, if you recommend bonds in a slowdown, justify it by noting that yields often top out and then decline sharply at the first sign of a slowing economy.
We've officially dissected the cycle. You've got the phases, the indicators, and the math to avoid the traps.
If you understood this business cycle breakdown, you're going to need the next module on yield curve strategies to understand how to position your fixed income portfolio for these shifts. Subscribe so you don't miss the next module and keep that trend rate moving upward.
Wow, TalLe, we've really put the business cycle through the ringer today. From the dog on the leash to the chutes and ladders of regime-switching math, I feel like I could explain the output gap to my barista.
That is precisely the level of intuitive comfort a candidate needs, James. But we must remember the business cycle is not a static map, it is a dynamic process. To beat the CFA Institute at their own game, you must be able to identify the current phase, justify your asset tilt based on central bank behavior, and know when to let the long-term historical averages take over your forecast.
Right, because the business cycle is just one piece of the puzzle. If you understood how these phases shift your asset allocation today, you're going to be in trouble if you miss how the yield curve reacts to global central banks.
Exactly. If you've mastered this breakdown of the 5 phases and the informationless average, you built the foundation. Our goal is to ensure you don't just memorize these phases, but master the logic behind them. If you can internalize the relationship between rising wages in late expansion and the inevitable shift to quality stocks in a slowdown, you are well on your way to the finish line.
Don't get trapped by appraisal smoothing or forecasting bias. And that's the win for today. But this is just one piece of the Level 3 puzzle. If you understood this portfolio breakdown, you're going to need the next video on yield curve strategies to understand how to position your fixed income slice for these exact cycle shifts.
To ensure you are fully prepared for the morning session, you need to keep this momentum going. Your journey to the charter depends on consistent, logical progression.
That's right. First, you need to hit that button and subscribe so you don't miss the next module in this series.
Because our only mission is to help you succeed by translating this dry curriculum into a clear mental roadmap you can use under pressure.
We don't want you just studying. We want you seeing the results on every practice exam and ultimately on game day.
Stay analytical, keep focusing on the core logic, and we will see you in the next session.
Catch you on the next loop. Bye, everyone.
Excellent progress today.